Welcome, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer, as a reference point. We expect you to do your own financial research and make your own financial decisions. Today is Sunday, June 13th, 2021, and this is Blockhead Traders Weekly. In this week's episode, we have myself, Sprocket888, and I'm joined by fellow Blockhead trader Viper XL007. This week, we're going to be continuing our series in part 3 of how to start trading with the topic of trading strategies. Now, there's no way that we're going to be able to even scratch the surface of the almost infinite amounts of trading strategies out there. But we are going to cover a lot of the key components of those trading strategies to give you the right tools to go out and do research so that you can familiarize yourselves with strategies that might interest you. But before we got into that, I want to give a shout out to the Discord channel here. You can find a link in the description below, but the Discord channel is a free and open Discord that is you can join to say hello to myself, Viper XL007, or any of the other traders that are in there throughout the day. We'll often post upcoming trades that we're thinking about. You can hop in there and ask questions to get a little bit more information on anything that interests you. We're going to jump into the trading strategies topic this week. So, like I mentioned, there are a lot of factors that go into trading strategies. Well, not actually a lot of factors, but there are some factors that kind of go in, and the combination of these basically are what create all kinds of different strategies. And so what we're going to do is just touch on a couple of the key components right here first, and then we're going to go into a brief description about some of the strategies that both Viper and myself use in our daily trading. The first point to call out is time frame. So this is one of the first things that you want to consider as a trader when you're trying to find what strategy do you identify with, what strategy do you like. And when you go out there to look for these different trading strategies, they kind of come in about 4 different styles. The first style is basically called scalping. A scalp is really just a very, 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 very short-term trade where you are trying to capitalize on very small movements in price. So a lot of times the length of time that you're holding on a particular scalp is a matter of seconds to maybe a few minutes. You're just kind of waiting for a couple candles to form and grab a couple candles in whatever direction your trade is, whether it's bullish or bearish, and then kind of cashing out. This type of trading typically is only done during market hours. It's usually very time intensive. You kind of have to sit there and be present for the entirety of the trade. But a lot of people do identify with it as easy to kind of set up, and you're really looking at trends on the most micro scale. And then if you take the next step down, which is called day trading. And day trading is a lot like scalping, except you're looking for a slightly more macro movement in the price. So, it really can be any length of time as long as it's within a trading day. So if you're doing day trading, you're basically opening and closing positions in a particular trading day, and you're not holding anything overnight. So all of your positions come off at the end of the trading day, and you put them on throughout the following trading day, and always clear your stuff out by the end of the day. One caveat that goes with that is you really want to probably have a portfolio size of greater than $25,000. And that has to do with a thing called pattern day trading rule. If your account has less than $25,000, trying a day trading strategy is probably not the best thing to start with, simply because of the capital requirements. If you have that, then great, look into it. Like scalping, it can be a lot of fun, a lot of action, a lot of movement. Again, it all happens during the market hours. You kind of have to be available during that and be able to get in front of your trading screen between the hours of 9:30 and 4 p.m. Eastern. Looking out a little bit more macro is what's called kind of swing trading. And swing trading is a little bit longer in duration than a day. So it could be several days, it could be up to a few weeks, really. And what you're really looking for is a movement in price over that period of time. And there's quite a few popular overnight strategies where you'll put a particular position on overnight, and you're just looking for that price to swing in the morning, um, and to close out that position there. I would probably say that if you do not have the ability to look at a computer screen during market hours to do trading strategies, swing trading is the first one where you don't really need to be that present during market hours. You typically do to get an entry and an exit, although you can pre-fill in those orders and they can go live at the market open timing. But yeah, this is one that your duration is now coming out to a few weeks. And then kind of the last trading strategy as far as time frame goes is what would kind of be known as position trading. And this is really where you're looking to establish a position in a particular asset. And that position is going to be there for, multiple weeks all the way up through multiple years. And position trading, you can kind of start to cross over into investing with position trading, in my opinion, because you start to look at the longer macro trends of whatever it is that you're trading. And so position trading, is typically the longest term trading strategy style that's out there. Now, in addition to the time frame, kind of the other big component in strategies is the what. So the time frame is the when, and the what is the asset vehicle. And there are all kinds of asset vehicles out there. I've kind of thrown up about 5 of the most popular, and I'll just talk a little bit about them. Probably the most commonly known and what everybody refers to as, somebody says trading, probably equity trading comes to mind. Those are your typical stocks, your Apple, your Google, your Chevron, your Marathon, those kind of names. So, alongside of that, very similar to that, you'll have ETFs, which are basically just electronically traded funds. And those are a collection of different stocks or particular types of assets or things like that kind of form a cornucopia of representation in that particular investment. Both equities and ETFs, really fall under the time frames that we listed above. You can scalp them, you can day trade them, you can swing trade them, you can position trade them. One of the other asset vehicles in here are bonds. I'm not familiar with a lot of scalping strategies or day trading strategies with bonds. I'm sure they probably exist, but typically bonds are usually used in strategies that are a little bit longer term. So they could be in swing trading, but most of the time you're going to find them in positional trading. And a lot of times the bonds are going to be a little bit more in the investment category. And so, you might want to hop back to our previous discussion in this how to start trading strategy in episode 1, where we talked about the differences between trading and investing. And the next couple vehicles that we're going to mention here are almost exclusively used in the trading world and not really much in the investing world. The first one I'm going to bring up are options. So options are one of the things you're going to see in my primary strategy. They are highly leveraged devices, which basically means, a dollar in an options world can control multiple dollars in underlying notional value. And they can be very flexible with how you utilize them. They're also typically only available to be traded during standard market hours. There's a few exceptions to that where some options on indexes like SPX and things like that are available past the market hours. But in general, most of your options are only going to be available to trade during market hours. and they're not quite as straightforward as your equities, your ETF, and your bonds as far as a learning curve. They're not terribly difficult, but they are definitely different, and you do have to kind of learn a little bit about, what is an option, how does it work, how do you trade it, but there are numerous and countless strategies pertaining to options, buying options, selling options, things like that. So, really go out and Google a lot of that, and you'll find all kinds of different strategies that are out there. The next vehicle is futures, and futures are they take leverage to a whole new level. So the notional value that a particular future can control can be very large. Bitcoin, for example, has futures, and one future of Bitcoin controls a notional value of nearly $300,000. A future on the S&P controls the notional value of I think it's like 200 and some $1,000, but the amount of leverage available in futures is extremely high. Futures are also available 5 days a week, 24 hours a day. They start Sunday night in Eastern around 6 p.m. and they go till about 5 p.m. on Friday, and they're traded continuously in that time frame at 24 hours a day. They do have, in my opinion, a very steep learning curve. So if we look at the different vehicles, equities are the lowest learning curve, options are kind of the next step up on the learning curve, and futures are even a step above that. And really the part that's difficult with futures is the way that they calculate the value of the future. So in stocks, for example, a dollar is a dollar, and a dollar is made up of 100 pennies, and each penny is worth a penny. When you get into futures, every single product has a different, what's known as a tick size, which is basically the value that it moves on the ticker screen. So in some, it looks like it's only moving a penny, but that penny actually represents $5. So understanding how they move and what the notional value is and keeping all that straight is a pretty steep learning curve. But in my opinion, it's pretty well worth starting to learn that. Additionally, futures do have options. So in the options world, you're not just limited to the options on equities and ETFs. Futures also have options. Another asset vehicle that's out there is Forex, which is currency trading. And to be honest, I do not know much about currency trading. I've read a little bit here and there. I think it's a relatively medium learning curve, kind of on the same order of the learning curve in options. I will caution you, please research it. In the readings that I have done, the types of traders that are in currency are extremely weighted towards institutional firms. And a lot of times I've read that it is very difficult for a retail trader to be very successful in currency. However, it is a vehicle that's out there. And when you're exploring different trading strategies, it might be worth taking a look at, because maybe that will turn out to be your thing. And the last asset vehicle is a relatively big newcomer. You probably have heard all about it if you've turned on a television, opened a newspaper, or even pulled up Reddit or Twitter, and that's crypto or cryptocurrencies. These are extremely volatile trading vehicles, which mean they have very large swings in very short periods of time, which is great for trading a lot of times. They are also, to my knowledge, the only asset class that is really available 24/7. That market never closes. It's always out there and always trading and always available. One of the potential drawbacks is there's not a lot of brokerage firms out there that offer cryptocurrency trading, and those that do offer crypto trading currency don't always have all of the crypto products. There is a tremendous number of crypto products that are out there to be traded.
Yeah, so mostly, I mean, so when we get into my trading strategies and whatnot, I'll come back to scalping and swing trading and stuff like that. One comment to make on crypto. So I've been doing some of that, and like I mentioned in a previous episode, like I've been doing it with a very small amount of capital, just to feel it out. And I've noticed that price level wise, price action is rules apply the same. You know, anything we've ever said about price action, it applies there as well. So I've been drawn into that 24/7 aspect of it because sometimes it's just more convenient to be sitting on the couch at 9 o'clock at night and wanting to spin a trade or do some scalping or something like that. But it's not without its I don't know what you want to call it, uniqueness or um, quirks, if you will. So like Sprocket mentioned, brokerage firm wise, it's really, I basically, I mean, there's a whole bunch of them. First of all, do decent research into any of them, because while the sad story we have lingering at some point is probably less likely to happen today, it's still a very real thing to have a bad brokerage in this wild west. So I chose Coinbase with mine because there's a lot of regulatory oversight into them. They are publicly traded, and I mean, Sprockets mentioned their ticker as things to watch for certain strategies or when they appear. So I just went with that, and then I just said, look, whatever coins they have, that's just what I'm going to work with. So it's limited, but it's not super limiting. They have 20, last I checked, 25 or 27 different crypto coins, all the big ones. Big ones meaning established in value. So like Doge, some people might think is big. It's just hyped, but Coinbase is adding it. They're about to add it, I think, sometime shortly, if not already. So I just stick with whatever they have. But I mean, I know like Binance is another name that's come up in the circles as one that a lot of people use. And the one key thing that I've really struggled with getting a handle on is crypto. I mean, it's like, if like, picture the normal stock market and picture a sector. So real estate or technology or something, like a sector is plucked out of the market and has its own market essentially. And so therefore, if crypto's up or if crypto's down, the whole thing is up, the whole thing is down, and it's really hard to run when the tides turn. I'm not saying it's impossible, because there are some assets like USDT or USDC, which are just tokens that are designed to match the US dollar. So you don't have to convert to USD. And so you can run into those when things are tanking. But it's a very manual process. And so I've kind of set my strategy where I use it to test some price action strategies. But I'm at the point right now where I've kind of locked into a few based on price action analysis. I've locked into more of a swing, not quite investor mindset, where I've kind of locked in 5 or 6 coins and I'm just going to let it ride for a few weeks. And I keep checking on it occasionally. But it is very interesting, and is certainly probably the mark of our era or generation. So worth looking at, but just understand there are some differences. And like we've said time and time again, bite small, start small, stay comfortable. So that's about all I have on crypto. So I don't know, what do you got for your
So we'll start
first
off with
strategy you want to go over?
my main strategy, and I'm really only going to kind of touch on the high points here. But I'd love to talk to you more about it if this thing interests you. Please hit me up in the Discord. send me a message, and I'd love to expand upon this strategy and teach you more if it happens to strike you. My particular strategy, one of the things that I derived at is I am not able to spend my day looking at a trading screen on my computer. I actually have a day job. This is not my main gig, and so I'm really limited the amount of times that I can actually interact with the market during the day. And so for me, the swing trading is the time frame that I really started settling into. And when I first started trading, investing, I dabbled in it. Um, probably 15, 20 years ago. I thought everything was stocks and ETFs. And probably about a year and a half ago, I really started saying, there's got to be more out there. There's got to be more to this. I always hear people talk about options. There must be something there. And I really didn't know what an option was. And that's when I really started kind of looking into options just to figure out, what is an option. And that led me down the path of actually kind of understanding an option is very similar to coupons or insurance. And the majority of people that trade them basically are either buying them most of the time for insurance against equity positions that they hold. And I started finding that there's quite a bit of strategies around what's known as premium selling. And this is really the bread and butter of what I do in my trading portfolio, and that is swing trading by selling option premium. And we can hop into this in future episodes, but largely what I do is I take very volatile stocks. So any stock that has very high volatility, and kind of like an insurance company in a region that might get lots of floods, tornadoes, hurricanes, right? The probability that there's going to be some major event in that area that an insurance company might have to insure against has what are known as higher premiums. So if you live in those type of regions, your insurance premiums are much higher because there's a higher likelihood that the insurance company is going to need to pay out. And what I found was that selling options is essentially selling insurance to these, retail traders, institutional traders of options and things like that. And the one thing that really grabbed my attention in the options world is they have expiration dates. But in addition to that, a lot of their pricing is all based on mathematical formulas. And you can research this and things like this, but with every position that you go and sell, it is clearly marked out the probability of that trade finishing what's known as in the money or out of the money at expiration. And there's a very complex formula that goes along with that, but in your trading platform, that value is distilled down into a number that's presented, and it's referred to as delta. And so what I typically do is I sell options that are about 35 to 45 days to expiration, because the value of an option decays over time. And what I'm doing here is the time decay speeds up exponentially as you start closing in under the 35 days. So I sell the premium just before it starts to really decay. And I typically start that premium selling out at what's known as a 16 to 25 delta, which basically means that there's only a 16 to about 25% chance that I will have to pay out on that insurance policy that I'm selling. So, these are high probability trades that have, a 85, 80%, 76% chance of actually winning. And, I have a whole strategy, and I typically target the ones that have higher elevated volatility, because much like the price of a stock, when anything is stretched beyond the mean, there almost always is a mean reversion. And as volatility comes in, the price of the option comes in. And as an option seller, once I sell that option, I pocket that money immediately. So as soon as I sell an option, the only thing I want to have happen is I want that option to lose value. And the faster it loses value, the more that my profits are kind of locked in. And so the key point here is the trades that I enter have high probability of profit that is based on mathematical formulas and things like that. So I feel it takes out some of the subjectivity in trading. The strategy is a very low touch strategy. So I'm able to kind of map out what ones I want to go after because, in the evenings, after my day job is over, I'm sitting around kind of checking out market, checking out stocks, things like where's everything at, decide which of those things might be good for premium selling. I can then enter my orders so that they execute when the market is open, which allows me to kind of do the things that I do in my day job. And it's not a trade that really needs to be monitored very closely because I'm trading these high probability trades and they don't really need any interaction throughout the day. So I can kind of set them, let them bake, let them cook, let them mature, and then take them off. And they're typically, 35 to 45 days to expiration. And in my rules, I basically only ever let them really get to 21. So, it's a very short term trade with high probability. Now, one drawback that I always tell people because everybody reads these stories about people turning $1,000 into $100,000 and things like that is you absolutely will never do that with my strategy. I equate my strategy to in the game of baseball, just hitting single after single after single after single. Um, I don't hit home runs. Hitting a home run with this strategy is really not a thing. It's just very constant, single, 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 and that's really my main strategy.
Yeah, I mean, I also feel like it's important to point out, and I mean, correct me if I'm wrong, because I like the analogy of single, single, single. If home runs are possible with this strategy, but in order to hit a home run, you are way over leveraging. You're just going way off the deep end with risk. I mean, because you would have to sell a gigantic handful, but I don't know. I guess maybe margin gets in the way to keep you from doing
Yeah.
that,
So
or
in
is
order
there
to really
something
hit a
about that?
home run, you really would need to have an outsized position open. So, with a lot of my rules, you can go back to our position sizing episode. And that's I never ever am all in on anything. And in order to really kind of hit a home run from the terms of revenue that or money that you bring in, you would have to have a significantly sized premium selling out there and that is really risky. So even though it's a high probability of winning, if you didn't win that one, your leverage that you put out there on that one position would do significant damage to your portfolio value if you didn't hit that. So one kind of quasi home run, let's call it maybe a double or a triple, um, strategy that I will do is really in the options world, buying call options are kind of the swinging for the fences type of thing. A lot of times you probably strike out, and that's usually makes it not worth it. But every once in a while, a particular underlying will go out there, and I'll want to buy a call option on that to try to swing for the fences. And what I do in that instance is I actually will also sell premium against that position to basically fund that position. So let's say that we have an underlying of, um, let's say Texas Instruments or some chip company, right? I might think that there's a high likelihood that they're going to just have this blowout event happen. And I want to buy call options. And those call options, let's say, cost, $2 or $3. So one of the things that I might try to do would be to sell a put against that same underlying to basically pay for that call option. And I would say that's the closest thing in my strategy that I do that would be more similar to a home run. But in reality, it probably is more likened to a double or a triple in baseball analogy. So the next thing that I'll just touch on
Hmm.
kind of briefly is secondary strategy that I have. And to be honest, this is a strategy that I'm just now starting. And so I don't have a ton of experience in it, but one of my goals in my trading portfolio is to really start to diversify the income streams that are in my portfolio. So today it is 99% founded around premium selling. But I kind of want even a little bit more hands off income stream. And so I'm trying to build out a section of my portfolio that is dedicated to dividend income. And I'm acquiring this by also utilizing my premium selling strategy that I mentioned in the previous slide. So, what I kind of do here is I map out different stocks that pay a dividend, and I'm looking for a medium dividend yield. So, I don't really look for super high yields and I don't look for super low yields. And the reason is if the yield is super high, it probably is that way because the stock is in some type of trouble or the underlying is in some type of trouble, and the ability for them to keep up the dividend that gives that high yield is probably pretty small. So it's likely that that company is going to scale back their dividend. And so what I look for more is how many years and quarters has the company actually paid a dividend, and what has that dividend been? Have they kept it constant for the past 5 years, 10 years, 15 years? Have they consistently increased that dividend size? And there's a whole filtering criteria that you can look up in Google about how to find good dividend paying stocks and stuff to bring into your portfolio. Now, the twist that I put on that is I just don't go out and buy them. The way that I acquire them is I sell a put against them. And I'll pick my target. I'll say, I think Apple is an excellent company to bring in for the particular dividend or something like that. And I will then sell a put that is much closer to an at the money, so much closer to a 50 delta. You know, maybe it's a 45 delta or something like that. And what that does is it allows me to collect premium on it. And if the stock falls in the money, then basically I get assigned that stock and I will pay whatever that strike price is that I sold, but I get to keep the money from the premium that I sold. And so essentially what it's doing is it allows me to enter at a lower price, because it usually means the stock has to fall from its current price to become in the money. So I'm getting in at a lower price. Plus, because I collected a premium from selling that put, it allows me to lower the overall cost basis when you look at the net cost of acquiring those 100 shares per option contract. And one of the other things that I kind of am throwing into that is I'm looking at what date do those stocks pay out their dividend, and I'm trying to space them out such that I can start building a dividend income every single month by looking at, oh, this one always does the first month of every quarter. Oh, this one always does the second month of the quarter, and so on and so forth. And so when you start looking out quarterly dividends, and you start to space them out in those different quarters, you can kind of acquire and slowly build up a portfolio that is going to pay monthly dividends to yourself to basically further compound your investment. Those are just two of the primary strategies that I use. I think we're going to switch over now to some of the strategies that Viper uses in his trading.
Yeah. So on my main strategy, we'll call it main strategies. There's kind of two of them that I go between here. The swing trades on selling options is really a lot of what Sprocket was just referring to. Just a couple tweaks. I mean, they're not really that different than anything he does. I mean, it literally came from him as far as where I started to get into these. But I pretty much stick exclusively to equity options. And I do the same, try to sell about 35, 45 DTE. And again, sell only when volatility is elevated. And for me, because I have this other, like obviously has a whole um, filter, thing that we've gone over on previous episodes. Um, so he's going in on a lot, different, anything that fits this filter. He's digging a lot into those results. I'm a little more specific on when I want to get in because I also have these holding shares on swing trades going on. So what I mean by that is for the especially naked puts, I'm looking for a significant event, and I'm most comfortable with selling naked puts. So I'm looking for, like we've talked about previously, with a big dip on an underlying, particularly after earnings. I really like big drops after earnings. Um, Something where the stock has clearly gone oversold. And we can tell that by looking at various levels of VWAP as to if something is oversold or overbought. Um, and I'm looking more in the 30 to 35 delta range. And some of that is because I am more selective on these plays. So I'm not loading up a lot of singles, and I'm also not hitting home runs, but I'm looking for just something with a little more meat on the bones. And so I'm a little more specific in that range. And then obviously complete strategy will have entry and exit rules, which I lay out going into each play. The general rules of that is just typically what's my break even. So obviously if I sell a $15 put for X amount of money, do the math, find out that $12.50 is actually my break even, and I put some rules and mechanics in place to make sure that I am comfortable with my risk. The other part of my primary strategy is swing trades on holding shares. So this is your basic price action, price level trading stuff. I buy or sell. I mean, in the market, as long as I've been in it, with the exception of the big COVID drop, it's a bull market. So I really don't do much on the sell side, but I would if we were in a bear market. And so I just do the swing analysis, price action levels, stuff we've talked about on previous episodes. I'll enter when I find something I like. And I mean, there's so much out there that I really stick to. Do I see this? I'll even run trades by whether it's Sprocket or someone else in my trading community that I look to for advice or sanity checking. So, I mean, I don't just jump into whatever looks good. That's confirmation bias. You're going to wreck yourself. So I will find something that meets all this criteria. I'll give it, the fifth degree. And then just to make sure, and this is part of my being as robotic as possible, almost exclusively, these go in as OCO orders. And an OCO order, I believe, stands for one cancels other. And so basically what this lets me use the system to force me to stick to the plan that I made. So let's just keep sticking with simple numbers. $15 is my buy. Let's say a stock is coming down. It's at $16. I put a limit order in. If it hits 15, I want to grab that, say 100 shares. And then this OCO order will actually ask me, what's your stop? And so I put in, let's again just say $13 is my analysis said $13. I need to quit. I need to run. So I put in $13, and then it also makes me put in what's your sell. Well, they're both sells, but what's your profit sell? So let's say this underlying is, I'm saying conservatively 17. This is again not swinging for the fences. I'm not trying to get home runs. I just want to make money. So I'll steadily. So I will look at what I think swinging for the fences price is based on the levels, and then I'll pull myself back to a more stable, like, okay, it should more likely hit this than that one. So I'll set that as my other end of the OCO order. So now when I send it, that thing's done. No matter what happens on that underlying, I get stopped out. It's sold. I've calculated my risk. I've managed it. If it goes up, it hits that level. It's sold. It's done. That's it. So that's where on the previous episode I mentioned using the system to make you as robotic as possible. This is my biggest way and my main strategy of how I do that. And generally I set one main profit target within reason. So that's like what I said. If I'm super bullish on something and I want to set multiple price levels, multiple profit targets, I'll do my OCO order. And then I watch it because I don't believe you can stack orders on the same underlying. So I'll watch it, but I'll leave, let's say 100 share. So let's say it was a 100 share position. I'll say 75 of these sell at that first profit target, but then 25, I want to roll some dice and, I want to push for that upper target. So I'll leave those as a runner. And then in that case, I got to keep watching. If that first one hits, then I can go ahead and enter where I want, put that order in. But I don't do that as much, but that's one way that you can still be bullish. You can still swing at the fences and balance yourself. So these are my two main strategies.
I want to kind of chime in a little bit here because I want to emphasize that you're never going to actually find your perfect strategy when you go researching things. And what I want to kind of call out here is actually when I first started talking to Viper about his type of strategies, which at the time was more focused on these swing trading, holding shares type of trades. And we started talking about price action and, I was mentioning, oh, well, I sell premium and here's where I sell it. Here's why I sell it. And he's like, oh, yeah, that's real interesting. That's nice. But, I really like this swing trading, holding shares. I just kind of look, I charted out these levels and then I make this move and I'm pretty sure it's going to work out because, I've predefined these levels and price action. And if it doesn't, I've got these nice stops in place to kind of contain my risk. And the more that I started looking at it, the more I was like, wow, I can actually take some of the things that he's using here, the price action and the levels and, the oversold conditions and things like that. And I can incorporate those into my screening mechanism and my premium selling. And likewise, I think when he mentioned some of his option selling stuff, he's still kind of tweaking some of the stuff that I do in option selling. And the point that I'm calling out here is, be in a community, be engaged with somebody in trading, because what you're going to find is the more people you talk to and the more data points you expose yourself to, you're going to develop your own flavor of trading. It's kind of like different chilies or things. There must be 5 million different styles of chili out there, right? And somebody tastes something that they like and they say, oh, I really like this thing in your chili. I'm going to add it to my chili. And I think that's the most awesome thing as a trader is to take in these data points from all these other traders. Nobody's right. Nobody's wrong. Everybody just has their style and what they enjoy and what they're comfortable with. And the more you expose yourself to that diversity, the more robust your own trading strategy will become for yourself. So I just think that's a real cool example on a micro scale, just the interactions that I've had with Viper between the different strategies that we both employ. I think he would agree that we've both come to a combination of everything independently.
Yeah, absolutely. And it definitely it has gone both ways because it would we called out briefly back in earnings season that we both have looked at the same earnings play. And it almost became somewhat of a game where Sprocket would tell me, well, first I would go chart whatever the underlying was having earnings. I'd go chart it with price action. He would chart it with his metrics that he was looking at. All of a sudden, we're coming to the same numbers. So these things are adding up. And so I've definitely taken a lot from the pure options play, applied it to the swing trade on holding shares. And then I've actually become more comfortable with the options plays because of the pieces that it's incorporated from the swing trading, the price levels, and all that kind of stuff. But also, very important to pause and take a step back to also full disclosure in how many videos and how many articles I've read of different trading styles. I still watch all kinds of videos of different scalping patterns or day trade patterns or things that I haven't even really been comfortable enough to dig into yet, but I'm still learning things from them, and I'm like, oh, that's really not for me. But the Chilean outlet, that's one little thing that maybe I could use that. And it started out, I couldn't even identify what I could use. I would just blindly watch somebody that was interesting, see what they're doing, see if it checked out as far as, makes some sense. And then I slowly built from there. So I definitely want to make that admission loud and clear of any confidence I have in anything we say. I'm sure it goes for Sprocket as well. Any confidence we project is just purely based on all the learning process along the way. For me, videos along the way, articles along the way, where when I started, I had no idea what I was watching. It was a foreign language, but just kept doing it and then started pecking, this, little that, which is also how I came across my second strategy. The second strategy, this is one that I would love to do a deeper dive in the future. And some of that is so that way I can have a better handle on it. But it's this idea of overnight scalping. And one of the things that this really can benefit is if the idea of scalping is something you're interested in, but you aren't a pattern day trader. So you don't have that $25,000 sized account to be able to day trade without penalty. And if you're less than 25, go, Google and look up pattern day trade rules. Be very familiar with that, because even in any strategy, you might slip into, I got to close this, you might slip into a pattern day trade. And so just know your limits there. But with this overnight scalp thing, pattern day trading, it's a day trade. So it's all within the same day. So what I like about this strategy is it lets you kind of dabble with the scalp idea, and then you do it overnight so that anything you close happens the next day. So you're opening on one day, you're closing the next morning, generally before the market opens. That's all above board, no matter what size account you have. So in this case, I seek a particular pattern. Basically, the high levels of it are the underlying is coming off a bit of a bear run or a big drop. There was a period of leveling, and now there's a clear indicator, higher lows, sort of thing, where it's starting to recover. And then I go one step further, and I make sure that it's recovering and it's about to close. Well, it does close. One of my requirements is it closes just above a recent low. And so it's overcoming a resistance level. It's basically what I'm looking for. I'm also not looking to take this position for any more than 1 to 3 days. And like I said, ideally I take it just before market closes. So I open it around 3:30 p.m. is when I'll go start searching these out, see if anything hits. There's plenty of days nothing fits the criteria. Move on. No trade is a trade. And then ideally pre-market opens, it does a little pump up. I sell it because once the market opens, it doesn't usually hold up there. So some key elements or some key aspects to this, like I said, clearing a recent level of resistance, a recent important level of resistance, and that would be a lot more easier explained if we do more of a deep dive into this. And then there's a gap to the next level. And what I'm trying to leverage here is a pre-market pump before the price normalizes. And so therefore my trade is generally executed after hours. So what I mean by that is the thinking here is we close above a recent resistance. So now the underlying, the market movers, it's attractive. It's attractive because it cleared a resistance. So money's going to come into this thing. And generally that big money comes in pre-market. If something's favorable, like it just closed above a recent level of resistance, pre-market is generally very kind and favorable to something in that position. So there will be a little, up action. But that's because it's a very small amount of money that's dabbling in that. Then when the market opens and everything, all other factors come into play, the price generally doesn't hold what it had in pre-market, and it might actually drop. So that's why sometimes I won't even hold it on open. This was a gamble play, kind of reminiscent to our earnings plays that we do for earnings seasons, much more gambling of sorts. So sometimes I'll just sell it if it's even, if it's not much profit, if it's a little bit of a loss, and I'll just move on. But if it's something that I really do like the pattern that I'm seeing, I'll hold it for a couple days. I'll take a lower close as long as the underlying, higher lows trend is continuing. Then I'll keep to it. But like I said, this is one still feeling it out. So if it sounds a little confusing, it's probably because I'm still bumping through it. But I'm very interested to. I've had one pretty good success with it. One didn't do anything, but I'm trying to build that experience, and then we can bring any of these strategies more into the light and kind of put them more under the microscope for curious minds. By all means, let us know.
So that kind of brings us to the end of the trading strategies episode here of how to start trading. And I just want to kind of close with a couple of comments here. And, I really like analogies. I think analogies really kind of help connect abstract topics in people's minds a little bit better. And, maybe you made it all the way to this part in the video and you're like, but he didn't really ever tell us what a strategy that is. And I liken a lot of this type of talk. I'm kind of an avid person that likes to cook things. I have a smoker. I love to smoke, brisket, pork, ribs, all kinds of things. And I watch so many different videos on that. And, you have lots of variables. You have the different meat that you can use. You have the type of fuel that you can use to cook. Is it an electric smoker? Is it a gas smoker? Is it a charcoal smoker? Do you use hardwood? What type of wood do you put in there? Cherry, apple, hickory, mesquite. What did you season the meat with? Salt, pepper, garlic. And I kind of liken all of this different trading strategy research into different recipes, where recipes are really guidelines for you to kind of follow, figure out what do you like about this? What do you like from column A? What do you like from column B? Oh, I can't stand the taste of chicken. I probably shouldn't use chicken. That's really where we're hoping to kind of give you some of the key components for you to go do your own research into all the countless and endless strategies that exist out there in the world. And it's really, Viper mentioned about how many videos he watched. I've probably watched just as many, if not more, videos on all types of strategies. And a lot of times I'll watch them and say, oh yeah, okay, I get that. That's not for me, and move on. But sometimes I pull little nuggets out of there, and then I kind of add them to my flavor of trading. And so really that's what this episode is all about, is about giving you different perspectives, giving you different ideas, encouraging you to go out, watch your own videos, read your own articles, do your own research. So everything that I have done, every learning that I've done and come across and acquired, none of it needed any money out of my pocket. There are so many free resources out there. Please do not go and pay money to somebody for their strategy. There is no secret get rich quick out there. There is no secret strategy that no one else has discovered and you can have it too for $9.99. Just please keep that in your mind. You should not have to pay for anything.
That's not necessarily to say there's all information you pay for is bad. It just means It just means you don't have to. It just means that there's motives involved and there's reasons, that someone that's their way of investing. They're investing in sharing their knowledge. That's a choice. And you what we're trying to say is you don't have to be a part of that. Doesn't necessarily mean it's bogus, but it is. Be careful.
But aside from that, have fun exploring, figure out what interests you, and let that guide you into your own flavor of trading. And once you start building that, get engaged in a community, share your flavor of trading, listen to others trading. No one's right and no one's wrong. Take everything as a data point and just let it build you up as a trader.
Um, but certainly, everything we've talked about, this is all where we're at today. June 13th. This is where our minds are at in our strategies. We are far from experts on them, and always growing through engagement with the community. So we would love for our community to be part of yours, but don't make one community your final stop. Find many other YouTube channels after you've subscribed to ours. But just be a sponge is my closing analogy.
Absolutely.
Sponge it up.
So this was installment number 3 in our 4-part series. Next week, we're going to talk about opening your first brokerage account to really let the rubber hit the road on your trading journey. But that's the end of this week's episode. Good luck this week out there in the market. Have fun. Remember to do your due diligence on items, and remember to always think outside the block.